Welcome to The Explainer. All right, let's jump right in. I want you to imagine we're sitting in a boardroom right now, and I'm your hedge fund manager briefing you on a massive, undeniable market mispricing that's playing out on the Colombo market as we speak. The asset? Sampath Bank. We're going to look at the hard data today and uncover a truly fascinating valuation paradox.
Because think about it, it's kind of the ultimate scenario for any value investor, right? What if you could buy a genuinely top-tier bank for pennies on the dollar? I know it sounds like a gimmick, but today we're going to unpack the actual hard data behind an institution whose underlying fundamentally elite quality is just almost entirely disconnected from its bizarrely low market price.
Okay, let's dive into this. 5.69x. That right there is the bank's price to earnings, or PE ratio. So in simple terms, for every single rupee of earnings this bank generates, investors are paying just 5 rupees and 69 cents. Now, you already know that generally speaking, any PE below 8 is considered undervalued. Trading under 6, that is incredibly cheap for a highly profitable, growing institution.
And you know what? I'm just going to give you the punchline right up front. After crunching the numbers across valuation, profitability, growth, and risk, this asset scores an 89 out of 100 on our investment grade scale. That firmly places it at the upper end of the strong buy category, honestly bordering on exceptional. My challenge to you throughout this explainer is to follow along as we unpack exactly why this asset graded out so unbelievably high. To start off, let's take a bird's eye view of the pristine fundamentals we're dealing with here. These aren't just okay numbers. These are metrics that earn perfect 10 out of 10 verdicts. Look at the PEG ratio of 0.54, meaning its growth drastically outpaces its valuation. You've got a return on equity of nearly 18%, explosive 27% loan growth, and a liquidity coverage ratio nearing a 240%. This completely proves we aren't just looking at a cheap stock, we are looking at a fundamentally elite company.
Section 1. The engine. Profitability and growth.
Because, look, before we get all excited about how cheap the stock is, we first need to prove this company actually knows how to make money. And wow, do they ever. Sampath is generating nearly 18 rupees of profit for every 100 rupees of shareholder capital. That translates to a 17.93% return on equity. In the banking sector, anything above 15% is considered excellent. This is arguably the absolute most important metric for any banking institution, and they are literally crushing it.
Now, what's really interesting here is that final bar on the right, that explosive 27% loan growth. You can see very healthy, steady momentum with profit growth at 11% and revenue growth at 12%, but a 27% expansion in their loan book. That is an outstanding figure. It's the primary growth engine of the bank, signaling massive, undeniable market traction.
But hey, growth means absolutely nothing if you're burning cash to achieve it, right? And that brings us to their cost-to-income ratio, sitting at a highly impressive 42.7%. Just for some context, keeping this metric below 45% is the gold standard. It proves the bank operates with ruthless efficiency, keeping their overhead super tight while the revenue aggressively scales up.
All right, moving to Section 2, the shield, capital strength.
Since banking is fundamentally a business of risk, we need to be absolutely certain our money is safe. And this brilliantly illustrates the substantial capital buffer protecting shareholder equity. The regulatory baseline, the minimum capital adequacy ratio required, is 13.5%. Sampath isn't just scraping by here. They are sitting incredibly comfortably at 17.65%. That's a massive safety net that far exceeds what regulators demand. We also see this really strong defensive posture in their asset quality. Their Stage 3 loan ratio has drastically improved, dropping all the way down to a very healthy 3.31%. Typically, if this number crosses the 5% threshold, a bank gets put on a watch list for concern. Staying well below that line, that means their loan book is remarkably clean.
Section 3. The reward. Dividends and yield.
So while you wait for the broader market to wake up and correct the stock price, you are actually being heavily compensated. Just take a look at this dividend yield, 7.03%. In a market where your average banking dividend payout might hover around an uninspiring 2 to 4%, a 7% yield is a massive premium. It's an exceptional, tangible return on your investment right now, literally just for holding the stock.
And management perfectly threads the needle here. They operate on a 40% payout ratio. What that means is 40% of their earnings go right into your pocket as dividends, rewarding you generously today. Meanwhile, the remaining 60% is retained. That retained capital acts as the fuel for all that future expansion, like that crazy 27% loan growth we talked about earlier.
Section 4. The catch. Weighing the risks.
Now, no investment thesis is complete without analyzing the downside, right? We have to look at the elephant in the room. And the most glaring issue is this massive effective tax rate burden, 52.3%. Yeah, that means more than half of their earnings are eaten up by taxes. This significantly limits pure profit growth and acts as a major drag on the bank's bottom line. In fact, it's significant enough that it caused a full-point deduction in our overall scoring model.
You also have to weigh the broader macro threats. The bank's net interest margin has dropped from 4.90% to 4.11%. And look, the whole sector is continually exposed to economic slowdowns and interest rate cycles. But compare those sector risks against Sampath's proven institutional moat. They hold domestic systemically important bank, or DSIB, status. They have a track record of paying dividends consistently since 1988. They have successfully recovered from past crisis years, and they command a massive base of over 4 million customers. It is a deeply resilient franchise.
Section 5. The math, valuation, and verdict.
All right, let's move on and see how this builds when we put aside the narrative and calculate the exact fair value using hard, undeniable math. If we use the PE method, we arrive at a fair value of 206 rupees. The dividend yield method, that gives us 189 rupees, and the price-to-book and ROE-based methods converge right around 214 rupees. Now actually, scratch that. There is a Graham-type valuation that spit out a wildly optimistic 297 rupees, but we are explicitly ignoring that to stay conservative and grounded in reality.
So when we blend those conservative models, we arrive at a weighted fair value of approximately 215 rupees per share. Now, compare that directly to the current market price of just 146 rupees and 50 cents. There is an astonishing, gaping delta between what you're paying on the open market today versus what this asset is fundamentally worth.
To fully contextualize that delta, we like to look at margin of safety zones. Buying below 130 rupees is considered exceptional. Between 130 and 155 is very attractive. 155 to 180 is attractive, and 180 all the way up to the 215 fair value is the fair buy zone. At a current price of 146.50, we are squarely situated in that deeply discounted, very attractive territory. So the crucial point here is this. We are looking at a massive 32% discount to fair value. When you combine that deep margin of safety with their underlying elite operational metrics, well, it completely cements our 89 out of 100 strong buy thesis with absolute mathematical clarity. The fundamentals are superb, and the price is literally an absolute bargain. Which leaves us with one final thought to ponder today. You've seen the 32% margin of safety. You've seen the elite, near 18% return on equity. You've seen the 7% dividend yield basically paying you to wait. So, with a top-tier asset trading for pennies on the dollar, is the market's current mispricing of Sampath Bank your biggest investment opportunity this year? Thanks for joining us for this explainer. See you next time.